Hi candidates, welcome to another session of manifested online classes. So in this session, I want us to continue with the topic of reconstruction, and specifically I want us to look on an illustration which is based on a past paper question regarding how to account for external reconstruction. The specific question I want us we do is the question for May 2021, which was question number 2. 2. So we go through the question, we see what we are told and equally what the examiner was requiring. So we are told Swara Limited has been suffering great financial distress. The directors of Swara Limited decided that the company should be reconstructed. The following was the statement of financial position of Swara Limited as at 31st of March 2021. So we have the non-current asset, which include landed buildings, plant and machinery, furniture and fixtures, investment, goodwill, patent, preliminary expenses. And then we have current asset, which include inventories, trade receivables, cash at bank. And then we have the total assets. Then from there we have equity, which comprises of ordinary share capital, 8% preference shares, and then we have the profit and loss account balance. And automatically those are accumulated losses. That's why that figure is given as a negative. And then we have 4% debentures. We have the trade current liabilities, which include trade payables, accrued debenture interest, and then we have total equity and liabilities. Then we have some additional information number 1 up to note number 11 there. We are told number 1 that on 1st of April 2021, a new company called Twiga Limited was formed to take over the business of Swara Limited. Twiga Limited was formed with authorized share capital comprising of 600 million ordinary shares of shillings 10 each and 40 million 6% preference shares of shillings 100 each. Number 2, preference dividends in arrears were dividends in Swara Limited were 2 years in arrears. 3 ordinary shares of shillings 10 each credited at 5 in Twiga Limited would be issued for each preference share in Swara Limited. In addition, one fully paid preference share in Twiga Limited would be issued for every 4 preference shares in Swara Limited. The preference shareholders would, however, pay the balance to make the ordinary shares fully paid. 4, the preference shareholders in Swara Limited would forego half of the preference dividend in arrears and would receive a fully paid preference shares in Twiga Limited for the balance of arrears of the preference dividend. 5, 1 ordinary share of shillings 10 each credited at 5 in Twiga Limited would be issued for every 2 ordinary shares in Swara Limited. The ordinary shareholders would, however, pay the balance to make their shares fully paid. Number 6, we are told the debenture holders would receive half of their dues, excluding accrued interest in 6% debentures of Twiga Limited and balance in fully paid ordinary shares of Twiga Limited. Interest accrued on debentures would be paid in cash by Twiga Limited after taking over Swara. Number 7, we are told the trade payables would be taken over by the new company and immediately settled by issue of fully paid ordinary shares of equal value. Number 8, we are told the assets were transferred to the new company at the following values. So we are given the values at which now the assets were transferred to the new company. The assets which were transferred include landed buildings, plant and machinery, furniture and fixtures, investment, inventories, trade receivables, and cash at bank. And then number 9, we are told Twiga Limited paid shillings 30 million to Swara Limited to pay for dissolution expenses. And 10, Twiga Limited issued for cash and at par all the remaining ordinary shares and preference shares not issued as part of the settlement of purchase consideration on acquisition of Swara Limited. And 3, and note 11, we are told assume all the above transactions were completed on 1st of April 2021. So what was the examiner requiring? So in part A, we are required to prepare the following account in the books of Swara Limited: a realization account, Twiga Limited account, ordinary shareholder salary members account, and preference shareholder salary members account. And B, we are required to do what? To prepare a statement of financial position of Twiga Limited is at 1st of April 2021 after completion of the reconstruction. So basically this is a question for external reconstruction, because if you go back to the information which you are given in this particular question here, that is in additional information number 1, we are told that on 1st of April, that is now the start of the year, a new company which is called Twiga Limited was formed, and which is supposed to take over the business of what? Swara Limited. So what that means is that Swara Limited will be liquidated, and then its business operation, asset and liabilities will be taken over by a new company which is called what? Twiga Limited. Maybe you can just first of all have that here. We have the company which is called Swara Limited, which we are saying is the old company, which is to be liquidated. In other terms, this company is also called the selling company. And then the business operation, asset and liabilities of Swara Limited will be taken over by a new company, which is called, or which is to be called Twiga Limited. So meaning that this is the new company, or the purchasing company. The purchasing what? A company. So for us to be able to successfully answer this particular question, or once you come across such a question as a student, basically you need to follow 3 steps. Follow 3 steps. So the first thing you need to do, or step 1, you have to compute the purchase consideration. Compute the purchase consideration. This is the amount of money to be paid by the new company to the shareholders and the financials of the old what? Company. When computing this purchase consideration, we use the net payment method. Net payment method. Under the net payment method, the purchase consideration is computed by adding all the payments to the shareholders of the old company and to the other financials. Once you have computed that purchase consideration, step 2, you proceed and you cross off. You cross off books of accounts of the old company, and for you to do that, you need to prepare now the account we are required to prepare in Roman 1. So 4 main accounts: realization account, Twiga Limited account, ordinary shareholder salary members account, preference shareholder salary members account. And then step number 3 is you open the books of accounts of a new company, and also you prepare the opening. A statement of financial position of the new company. So these are the 3 steps you need to follow for you to be able to do what? To successfully answer that particular question. So what we need to start with is by computing the purchase consideration. We are going to compute this particular purchase consideration using which method? The net payment method, whereby we are going to add all the payments made to the shareholders and also the financials of what? Of the old company here, or the selling company, which is what? Which is Swara Limited. So the first working, or the first item we need to compute here is purchase consideration. Purchase consideration. And I've said we compute that by adding the payment made to the ordinary shareholders, the preference shareholders, and the other financials of Swara Limited. So if you go back to the statement of financial position of this company, that is Swara Limited, the old company, we can see from where we have equity in the statement of financial position, this company had issued ordinary shares. The company had also issued preference shares, and also this company had issued debentures. So we can say this company had 2 types of shareholders: ordinary shareholders, preference shareholders, and this company had also debenture holders as the financial. As what? The financial. So therefore, to compute this purchase consideration, what we need to do is basically to add now the payment made, first of all, to ordinary shareholders. We are going to determine a payment which was made to ordinary shareholders. Then from there, we are going to take into account the payment to preference shareholders to preference shareholders. And then finally we have now the payment to debenture holders. And equally, after adding all this, in most of the cases you'll be told that there was some liquidation cost which was incurred by the old company, but that liquidation cost was paid by the new company. So anytime you're given such information, that purchase consideration incurred by the old company but paid by the new company is also included as part, or is also considered to be part of the purchase consideration. So therefore, to this, we're also going to add the liquidation cost of the old company, but paid by the new company. Company. So let's do that, and for us to be able to determine this particular payment now to the shareholders and also to the financials of the old company, which is the Swara, we need to go back to the additional information. Let's go back to the additional information, specifically where we have the additional information number 3. So let's go to the additional information number 3. So in number 3, what are we told? We are told 3 ordinary shares of shillings 10 each, credited at 5 in Twiga Limited. Twiga Limited, you have to remember, is the new company, would be issued for each preference share in Swara Limited. So basically what you are told is that this company here, which is Twiga, will have to issue a number of ordinary shares to the preference shareholders of what? Swara. So why are the preference shareholders of Swara issued with the ordinary shares by the new company? Is for them to be paid. So therefore, what we need to do there is to determine the number of ordinary shares which were issued to the preference shareholders, of the old company, that is Swara Limited. These preference shares are automatically issued by the new company. So we are told 3 ordinary shares, and which are credited at 5. So basically that means that those particular shares will be issued to the preference shareholders of Swara for free to an extent of 5. But because the shares are having a par value of 10, the preference shareholders of Swara will have to pay the balance of 5 shillings to the new company to make their shares fully paid. But you're given that particular information there. So we are told the new company will issue 3 new ordinary shares credited at 5 for each, that is for one preference share. For one preference share which was held in Swara. So what we need to do first of all, we need to determine the preference shares which were held or which had been issued by Swara Limited. So where do we get that information? That information we get it from the statement of financial position of Swara, specifically under equity. What we need to do is we take the ordinary share capital of this company, which is Swara, and basically we determine the number of shares issued by this company. So of which this will be equal to 3.6 divided that with what? With 50. So let's work out that. We compute that, which will be, and that will give us 72,000. 72,000 shares. So these are the preference shares issued by our new company, or basically by Swara. Let me confirm that that is correct. Yes, so it will be, there will be 72,000. So what we need to do is basically to determine the number of ordinary shares issued by the new companies. So we cross multiply, then we divide 3 times 72,000 divided by 1. So and that will give us what? 72,000 times 3, which will give us 216,000 ordinary shares. So these are the ordinary shares which will be issued now to the preference shareholders of Swara as a form of payment. So therefore, the first payment to the preference shareholders here is that they will be issued with 216,000 ordinary shares, and which you are told will be credited at 5. So the preference shareholders will not be required to pay 5 shillings per share. Basically, that is a form of payment. That is a form of payment to them. So we have 216,000 times 5, and which will give us 1080. And remember, in this case, what you have said is that because these shares have a par value of 10, then automatically the preference shareholders of the old company, that is Swara, will have to pay the balance of 5 shillings to the new company to make their shares fully paid. Actually, we are given that information in that point number 3, the last sentence. Okay, before you go to that sentence, the last sentence of note 3, sentence number 2, we are told, in addition, one fully paid preference share in Twiga Limited would be issued for every 4 preference shares, for every 4 preference shares in what? In Swara. So other than the preference shareholders being issued with these ordinary shares, we also told they will be issued with what? The preference shares. So what we need to do is to determine the preference shares issued by the new company to the preference shareholders of Swara Limited. And we are told as in sentence number 2 that in addition, one fully paid preference share will be issued by the new company, which is Twiga, for every 4 preference shares which were held. So in our case, we know the preference shares which were held by the preference shareholders of Swara is what we have computed here, 72,000 preference shares. So we just cross multiply, then we divide, which now will be 1 times 72,000 divided by 4. Or we just take 72,000 divided by 4, and this will give us 18,000 preference shares. And you are told that these preference shares will be issued as fully paid. What is the par value per preference share? From additional information number 1, the par value per preference share is 100. So therefore, also the preference shareholders of Swara will be issued with 18,000 preference shares. Will be issued to them as fully paid. So let's multiply the 2, and this will give us 1.8. So therefore, what we are given there is the payment which was made now to the to the preference shareholders of the old company, that is Swara. So then let's go to note number, okay, before we go to note number 4, we are told in the last sentence of note number 3, although that is something I've explained, the preference shareholders would, however, pay the balance to make their ordinary shares fully paid. Remember, these preference shareholders of the old company, that is Swara, were issued with 216,000 ordinary shares, and which they were not required to pay 5. And because these shares are having a par value of 10, they will have to pay, the preference shareholders of Swara will have to pay the new company Twiga the balance of 5 shillings to make their shares fully what? Paid. So that is now an accounting entry which you are going to make in the books of account of Twiga, because that is money received by what? Twiga. So let's go to note number 4, and you are told the preference shareholders in Swara Limited would forego half of the preference dividends in arrears and would receive fully paid preference shares in Twiga Limited for the balance of the arrears of the preference dividends. So I think the first thing we need to do there is to determine the preference dividends which were in arrears, preference dividends in arrears, and we are given that particular information in note number 2, where we are told the preference dividends in Swara Limited were 2 years in arrears. How do we compute these preference dividends in arrears? We go back to the statement of financial position of Swara, specifically under equity, and we can see the preference shares issued by Swara were 8%. So the preference dividends to be paid by that company annually would be 8% of 3.6. That will give us the dividends per year. And because we are told those dividends were 2 years in arrears, we multiply that with what? With 2. That will give us the preference dividends in arrears for 2 years. So we have 3.6 times 8%, or 8% of that, times 2. So which will give us 576. So basically what you are told in note number 4 is that the preference shareholders of this company, that is Swara, will forego half of this. half of that. They will not be paid half of those dividends, and then you are told the dividends which will be paid now, which will be half, will be paid to them by being issued with fully paid preference what? Shares, preference shares. So meaning that the preference shareholders will also be issued with the preference shares, which are fully paid, and the amount to be paid to them is half of this. So what is half of 576 is 288. 288. So that is the amount now which will be paid to them by being issued with a fully paid preference what? Shares having a par value of 100. And I think in that case we can just determine the preference shares to be issued to them, the number which will be 28 what? 80. So we are done with that point. Let's move to point number 5. And we are told one ordinary share of shillings 10 each credited at 5 in Twiga Limited, which is the new company, would be issued for every 2 ordinaries held in what? In Swara. So basically what you're given there is the information regarding the number of ordinary shares to be issued to the ordinary shareholders, of Swara Limited. And we are told that one ordinary share and which will be credited at 5 will be issued for every 2 ordinary shares which were held in Swara Limited. So let's determine how many ordinary shares had been issued by Swara Limited. So we take the ordinary share capital of Swara Limited from the statement of financial position, 3 million, divide that with 10. So this will give us 300,000. So, and these are ordinary shares which were held. So therefore what we need to do, we need to cross multiply there, and we do what? We divide, so that we can be able to determine the number of ordinary shares issued by the new company, which is Twiga. So 1 times 300,000 divided that with 2. So it's just 300,000 divided that with what? With 2. This will give us 150,000 ordinary what? Shares. And we are told this one will be credited at 5. So that is now the payment to the ordinary shareholders who will be issued with 150,000 ordinary shares and which are credited at 5. And this will give us a figure of 750,000. But we just need to confirm we have 150,000 times 5. Yes, which will give us what? Will give us 750. So and then because these shares, the ordinary shareholders of Swara Limited were not required to pay 5 shillings per share, they will have to pay the balance of 5 shillings per share to the new company, which is Twiga, to make their shares fully paid. But the amount now to be paid by the ordinary shareholders of Swara will be paid to the new company. So that is something we are going to account for in the books of account of the new company, which is Twiga. So and then we are told number 6 there, the debenture holders would receive half of their dues, which exclude the accrued interest in 6% debentures of Twiga. Of what? Twiga. And then the balance will be paid by being issued with the fully paid ordinary shares. So basically what we know is that this company here, that is Swara, from its statement of financial position, it had issued 4% debentures. These particular 4% debentures have a value of 2.4 million. 2.4 million. So we are told the ordinary the debenture holders of Swara Limited will be paid half of this amount, which is 1.2 million, by being issued with 6% debentures by the new company, and then the balance of 1.2 will be paid, or the debenture holders will be paid this by being issued with what? The ordinary shares. So what we have there is the payment to the debenture holders. So number one, they will be paid by being issued with 6% debentures, 6% debentures having a value of 1.2, and also they will be issued with the ordinary shares which will be issued as fully paid, as fully paid. The ordinary shares, we know they have a par value of 10, and those shares would be having equally a total value of what? Of 1.2. So mean that we can be able to determine the number of ordinary shares. 1.2 divided by 10, which will give us 120,000. Yes, 120,000 ordinary shares issued as fully paid at a par value of what? 10. So I think we have that. Yes, and then note 6, the last sentence, we are told the interest accrued on debentures will be taken over by the new company Twiga and immediately settled in cash. That is one of the liability to be taken over by the new company. And then number 7, we are told trade payables will be taken over by the new company and also settled by issuing ordinary shares. And then number 8, we are given the asset which were taken over. That has nothing to do with the computation of purchase consideration. And then number 9, we are told Twiga Limited paid 30 million to Swara to pay for dissolution expenses. So we have said those particular dissolution expenses or those particular liquidation expenses which are paid for by the new company, we include them as part of the purchase consideration. And in our case, we are told is an amount of 30 million. Remember, our figures are in thousands of shillings. So we take it as what? 30,000. And I think having that now, we can compute now the purchase what? Consideration by adding all these particular forms of payment to the shareholders of this company and the other financiers who include the debenture holders. So we have 750,000 plus 1080,000 plus 1.8 million plus 288 plus 2.4 million plus 30,000. 30,000, and that will give us a total purchase consideration of 6348 what thousand. So this is now the purchase what consideration, and basically you have determined this using now what using what we refer as the net payment method. Now, having computed that, what we need to do next, remember I've said here we follow 3 steps in accounting, or basically in answering such a question. Once you have computed that purchase consideration, step 2 is that you proceed and you do what? You open, sorry, you close, not to open, you close the books of account of the old or the selling company. And then from there, next you proceed and you open the books of account of the new what? Company. So what we need to do